Building long-term generational wealth in the stock market often comes down to choosing the right passive index vehicles. For growth-focused investors, Vanguard has long been the absolute gold standard, offering low-cost exchange-traded funds designed to capture the fastest-growing companies in the United States. But a major source of confusion for retail investors centers around two specific flagship funds: the Vanguard Growth ETF, ticker symbol VUG, and the Vanguard S&P 500 Growth ETF, ticker symbol VOG. On the surface, these two funds sound completely identical and share the exact same top holdings. However, looking beneath the hood reveals critical differences in their core index methodologies, sector concentration levels, and underlying valuations that could drastically alter your long-term investment returns. Let's start by looking directly at the core structural designs of both funds, because they track two completely separate market indexes. The Vanguard Growth ETF, VUG, has been operating on the market since 2004 and tracks the CRSP U.S. Large Cap Growth Index. It maintains a highly concentrated basket of roughly 153 stocks. On the flip side, the Vanguard S&P 500 Growth ETF, VOG, launched later in 2010 and focuses exclusively on the growth-oriented companies already tucked inside the standard S&P 500 index. Because it utilizes different criteria to measure growth, VOG naturally holds fewer stocks, sitting around 145 holdings. Now, let's talk about the absolute number one factor that draws cost-conscious investors to Vanguard, which is the annual expense ratio. VUG is an absolute fee-crushing machine, boasting an ultra-low expense ratio of just 0.03%. This means for every $10,000 you invest, you pay a microscopic $3 a year in management fees. VOG is also highly competitive, but it carries a slightly higher expense ratio of 0.07%, costing you $7 annually for that same $10,000 investment. While a 4 basis point difference seems completely negligible over a single year, that slight fee advantage can compound significantly over a multi-decade investing horizon at a massive scale. VUG's lower fee structure has helped it attract an enormous asset base, managing over $350 billion in total volume, compared to VOOG's much smaller $22 billion footprint. However, the real differentiator that investors need to closely evaluate is sector diversification. VUG is an incredibly tech-heavy fund, with roughly 62% to 68% of its entire portfolio completely dominated by the technology sector. It represents a massive, highly aggressive bet on massive tech innovations like artificial intelligence and cloud computing. VOG takes a notably more balanced and diversified approach across sectors. It limits its total technology allocation to around 45% to 48%, spreading the remaining weight across communication services, consumer cyclicals, and financials. Because of the specific sector tilt, their concentrations in the famous Magnificent Seven mega-cap stocks vary widely. Both ETFs share the exact same top three holdings, led by NVIDIA, Microsoft, and Apple. But in VUG, these top three companies alone command a staggering 33.5% of the entire fund's weight. In contrast, VOG scales back that mega-cap exposure, dedicating roughly 27.2% to those same top three stocks. This structural difference explains exactly how both funds behave during different stock market cycles. In a massive tech-led bull market, VUG's heavier concentration can easily supercharge short-term gains. But when the tech sector faces a severe correction or a broader bear market, VUG experiences significantly higher volatility and sharper drawdowns. Historical data from major tech downturns shows that VOG consistently outperforms VUG by several percentage points during market drops, courtesy of its lower beta and milder maximum drawdown profile. Furthermore, VOG currently holds a slightly lower, more reasonable price-to-earnings ratio of 33.5, compared to VUG's pricier 36.8, alongside a marginally higher dividend yield of 0.54%. Ultimately, choosing between these two Vanguard giants depends entirely on your personal risk tolerance and market outlook. If you want a cheaper, highly liquid fund and want to maximize your exposure to big tech and artificial intelligence, VUG remains an outstanding choice. But if you prefer better sector diversification, lower overall volatility, and a slightly more undervalued basket of growth stocks to guard against potential tech sector cooling period, Paying the tiny extra fee for VOG is highly justified. Financial experts advise evaluating your current tech exposure across your entire portfolio before choosing where to deploy your cash. Stay tuned as we continue to track the best investment strategies for building long-term wealth.